So this is the appendix 13A in your book, and it's on sustainable income. So the best way to figure out sustainable income is to look at our multi-step income statement. And multi-step means it has quite a few steps as opposed to your single-step income statement. So with a multi-step, you're starting off with your sales revenue, you take off your sales returns and allowances, you take off your sales discounts, and you end up with net sales. Okay, so that's sort of the first step in a multi-step. The next is to go through your cost of goods sold. So you got your net sales less your cost of goods sold, and then you have gross profit. So that takes us the net sales of 5 less the 600 cost of goods sold gives us a 4,400 gross profit. So we got two steps. The third step would be your operating section, and this is all your operating expenses. These would be all the things that are the main, the main line of business that you do. So you might have sales commissions, you got your salary, your rent, your supplies, your depreciation, you'd have utilities, your regular operating expenses. You total your operating expenses, you go your gross profit, minus those, gives you your income from operations. Okay, so then comes the next step, which is your other. You get other revenues and gains, and other expenses and losses. So examples of other revenues and gains, this could be you're selling off some equipment, that's not your main line of business, but you have to trade or sell your equipment off once in a while, so maybe there's a gain on the sale of equipment. Perhaps you've got some interest revenue that's been earned on investments or various accounts. And so that's not your main line of business, but it's, part of what happened. And so other revenues and gains. So here's, if you were, if we had a long whiteboard, this 400, actually I just had sort of come up here, okay, so that's our income from operations. Now we've added 300 for our other revenues and gains. We've got some other expenses and losses. So maybe interest expense, maybe we had a loss on the sale of stock. Even something like a loss from a media strike landing on the warehouse. That would be an other expense and loss. That used to be several, until FASB changed it, there used to be a category called extraordinary items. And one might think that a meteor strike would be extraordinary, but it no longer is. It's just an other expense and loss. So that's where it would go if that happened to you. All right. So anyway, we had the 400 from our operations. We had our other revenues and gains. Now we're deducting our other expenses and losses. And then we come to our income before income tax. All right? Calculate the income tax expense, and we come down to net income. Okay, so now on the notes, you'll notice that this kind of goes on. There is another step in the multi-step, and that would be if we had discontinued operations. These are operations that maybe we just sold off because it could be a whole segment of the business we sold off. H&R Block sold off their mortgage division right before the 2008 financial crisis. That was a pretty smart move. So that would be an example of a discontinued operation. If we had discontinued operations, the net income would be changed, and it would be, instead it would be income from continuing operations, because we have discontinued, continuing operations. Okay, and then we would have our discontinued operations. And I'm going to refer you to the notes on this because I really don't have room to write that all out. So we will just go our discontinued operations. And I'll just talk about them a little bit. So say we sold off our trans fat division. The discontinued section is shown net of tax, and I'll do another example of this later. So the discontinued operations would be shown net of the impact of tax, because the income taxes for everything having to do with our continuing operations has been taken care of right here. Everything from this point down is shown net of tax. So if so, you'd have your you could sell off the actual plant, and that would be the gain or loss on that net of tax. And then you could maybe, if it were sold off, say in September, you would have had income or loss from that discontinued division. That would be shown as a separate item. And eventually you would come down to, after your discontinued operations, you come down to net income. Okay, so let's step back and think about this. From the point of view of usefulness, when we're analyzing financial statements, and this goes back to the sustainable income, we're trying to figure out what's the likely income level that this company is going to achieve in the future. And if we had to focus in on the one number here that would be the most representative of the sustainable income, it would be this right here, your income from operations. That's the main line of business, that's what we do. These are more incidental. They're, gains on the sale of equipment, the interest revenue, things like that. Those are more incidental, and how management handles them has something to do with how the operating results of the company. But this is the fundamental business of the company. So when we're looking at predictive of how this company is going to do in the future, this would be the most predictive. This would be useful information to have, but it's not quite as predictive as how the company's going to do in the future. And your income from discontinued operations, they're discontinued. They really don't have much to do with how the company's going to do in the future. So the concept of sustainable income, you kind of focus on the income from operations.